Today we're at the Astute offices here in Cairns and I'm joined by Phil. Phil recently helped me. We had a little trouble financing a recent duplex purchase. Come unstuck under a couple of different things which we might delve into during this conversation, but wanted to get Phil in today to talk about a few sort of higher level financings and what some people may think about it on the surface.
She's a bit dirty.
So Phil, thanks for
having me, Shawnee.
Nah, absolute pleasure. We'll jump straight into it. One of the most common things, I guess, mum and dad investors come across is accessing the equity out of their current home to buy an investment property.
Yep.
There's a number of different ways this can be done, but what are they and what's the best way to go about it?
Yep. So probably the first place we start is, if someone's got an existing property and they're looking to get into another property, one of the first questions we're asking is, how do you want to pay for the next property? So the first place we go is, do you have any equity in your existing property, or do you have some cash somewhere that you want to tip into buying the next property? Now, 90% of people don't have the cash, so often we're looking for equity in a property that they might have owned for a while and paid down, or they might have seen some capital growth over a long period of time.
Typically, most banks are lending on like a 10% equity position. Most people can achieve finance on.
So it just depends on whether they're trading up for an owner-occupied property or whether they're trading up for an investment property. So what I find most mum and dad investors do is they've bought the family home and they've been in it for maybe 10, 15 years. They've had some equity being built from just the rising property market.
Rising property and then loan pay down.
The debt.
Yep.
So if it's an owner-occupied property that they're going to, so trading up the new family home, we can go to sort of 95%, sometimes even 97, 98.
Yeah, okay. Yeah, really
and traditionally for an investment of late, we've been seeing around that 90, sometimes topping out at 92% inclusive of the lender's mortgage insurance.
Yep.
Yeah, we do have some options at the 95, but there's not often a lot of benefit in doing it, because what you find is once you get over that 90% base loan, the LMI premium just gets so expensive that 90% of the extra it's all LMI. It's all
not worth looking at.
Yeah.
So I guess there's two options for people upgrading or buying an investment property, and that's either paying cash or accessing their equity.
Yep.
To actually access their equity in that existing property, what are their options?
Yeah, so there's two options. One is we can cross-collateralize the two properties, so you can use the total value of what both properties are, and we treat them as sort of almost one house then. So you'll have maybe a $200,000 house and a $400,000 house. So your value based on that is $600,000, and then your loans would be added together as well, and it gives you that overall LVR. So say they had on that $200,000 house $100,000 worth of debt, and on the $400,000 house we were looking at say another $300,000 worth of debt. Well, then we've got a loan to value ratio based on 400,000 over that 600,000, which is
whatever
70% or something
whatever
like
it works out to be.
Yeah.
And I guess the con of doing that, and that's probably from my experience, is the general way most banks try and push you in is to cross-collateralize both properties. I guess then the banks have control of both properties.
Yeah, that's right.
The con, which I guess I've experienced, is if you go to sell one of the properties or go to refinance to buy something else, both the properties are locked in and both are getting valued versus the freedom of just having one.
Exactly right. So cross-collateralizing isn't my preferred method. I much prefer to do what we call cash outs or supplementary loans based on the existing property. And the reason is because dollar for dollar, it's the same money. The difference is the control you have over your next steps in the finance.
Yeah.
Well, if you want to continue to grow, it's very helpful, and also, well, the main reason it's helpful is because you have control over those loans. So by cross-collateralizing, you're very dependent on values at the time you go to do your next purchase, which is really hard to tell what that's going to be. So by having them separate and doing cash outs to use as our deposit for the next one, we have a lot more control over, whether the valuation stacks up with one bank than another, because at the moment you can see variances of like $50,000 to $100,000 in a
bank
valuation.
valuations
So
can be-
depending on who turns up on the day. So it just gives you a lot more control when you go to sell, and also if you have a real big bump in one market as opposed to the other. So at the moment, if you had property in Melbourne, you'd see your valuation, I would imagine, going up a little bit, whereas Cairns is quite flat at the moment as far as vals go. So you'd be able to take advantage of that extra equity here, whereas you might not have seen
without
that
relying
growth
on that secondary property.
Yeah, exactly.
So yeah, that's very much what we've experienced, and the way you structured our loans, we've got that option now. We can sell any of our properties without having to throw in equity into another, which is a problem.
Yeah, you sort of don't have to go as much hat in hand to the bank, because when you put the release in, you're literally closing off the loan that sits against that property, as opposed to dealing with two properties, getting two valuations, being completely at the mercy of the bank. So a lot of banks like to do it because it keeps you very sticky to that bank, and that's the main reason they do it. So you'll see a lot of offers out there at the moment for refinance rebates. Well, sometimes people can't take advantage of that because
they're crossed up
because they're all messed up, and
So essentially the terminology was cross-collateralizing, where you've got 2 or 3 or 4 or 5 properties all tangled up, all the titles interconnected.
Yep.
And then the other terminology was a cash out.
Yeah, cash out or an equity release to then be used as our deposit. So an example of that might be, let's say for example you were buying a house for $400,000 and you needed a 20% deposit to come from somewhere, and you had existing equity in your family home. So we'll use $400 for an example as the new purchase price. You'd be able to cash out $80,000 against this existing
Property,
family home to then be used as your deposit for your next purchase.
Yeah, makes a lot of sense. And I guess the other pro to doing a cash out refinance is you can almost hack the valuations. If you've just, say you're in a unit complex and there's just been a really good sale in that complex, the bank valuer is going to go against that really good sale, so you can time and almost do a cash out before you're looking to buy. Would that be possible?
Yeah, and of course, we can definitely take advantage of those uplifts in vals. I suppose the buyer beware and be careful bit is, you don't want to take advantage of a great val and then have, realistically it might
Negative
be worth
equity,
less, and then, over leverage a property. So, but yeah, it certainly is a great play if you are motivated to really push if you have a high risk tolerance, I suppose.
Yeah, you're trying to push the boundaries, looking to sort of a high growth portfolio and really trying to leverage every bit of money that you can get your hands on. I guess,
absolutely.
There's those tools to do that. The other thing I wanted to talk about was the advantages of an offset account. So some banks offer them, some banks don't. Some people utilize them, some people don't.
Yep.
Can you explain a little bit what is an offset account and the pros and cons, I guess, of having it?
Yeah, of course. So personally, I have an offset account, so I really do like offset accounts. There's pros and cons to everything. So if you've got a very small loan and it's and generally we find loans under 200,000. I find it's not rare, but it's unusual for us to want to put it in a package where we have an offset account, mainly because you're paying that $395, $299 per annum to get access to it, and the rate might not be quite as sharp as you could get for a basic home loan. The pro to the offset is if you are investment savvy and looking to reach out and go to buy that next property and turn it into it, is on your existing family home, you might fill up your offset account, which dollar for dollar reduces your loan as if you were paying the money into the loan. So an example of that would be is if your loan was $100,000 and you had $100,000 in your offset account, you would still be making your payments each month, but you're just reducing balance, or
you're paying zero interest. You're essentially
exactly.
In the bank side, you've got a loan for zero because the offset's 100% cancel out.
Yeah, so there's no interest being charged on that loan. So the benefit there is if you then go and buy another property and want to use your existing owner-occupied property as an investment, well, you haven't affected the debt's purpose. So, check with your accountant, but certainly it
bit of a loophole there.
It would appear. It is usual that you are able to then claim that.
Going into a little bit of accountant advice there, but essentially, I think where you're going is you can have a loan against your primary residence, but have that 100% sitting in an offset account, but then you can redraw into another property, have that loan against your home. You
can use the offset money to then go and buy something else, and then that interest that's being charged, because that property then becomes an investment property, is then
a tax deduction.
Can be a tax deduction. Yeah.
Nah, 100%. And look, it's as you said, it's something you use, it's something I use. I think there's a lot of merit to having an offset account, especially if you're starting to rack up a bit of savings. If you don't have a lot of savings or cash in the bank, there's probably no merit.
Well, that's the other thing. So some people, it's just not for them, and they like to see the bank balance reduce, so the loan balance reduce, and that's fine too. But it for individuals, and if you are interested in growing, then and buying more properties and having investments, then offsets are great because you really can maximize your money.
Thanks for joining us today, Phil.
Thanks, Shaun.
If you do want to have a chat to Phil, if you are looking at borrowing cash, I really recommend reaching out. He knows what he's doing in this investment space and knows how to get deals across the line that your bank may just not be able to offer you. So if you do want to reach out, his details will be down in the description. If you have enjoyed the video, make sure you hit the like button. And if you do want to see more, make sure you subscribe. I look forward to talking to you soon, and have a fantastic day.
You could say, click the link, subscribe to the channel below.
Exactly right. Exactly right.